Hi there, fellow investors. It's not even the middle of the year yet, but I'm already feeling seasick from the wild ups and downs of the markets in 2025. It's like watching a weather report in a tropical storm. 1 minute, tariffs on China. The next, tariffs scaled back. Wait, Fed pivot? No, sticky inflation. Then suddenly, the US Nasdaq rallies like nothing ever happened. It's been months of rally, plunge, rally again. Like riding a sampan in a storm. One moment you're up on a wave of optimism, the next you're hanging over the side as the market lurches with every twist in policy headlines. But through all this noise, I stuck with a simple idea. When markets lose their mind, dividend stocks help me keep mine. They're not the flashiest speedboat, but they're the stabilizers that keep my portfolio upright when the waves get wild. Not just for the yield, but because dividend-paying companies tend to be the ones with real cash flow, strong fundamentals, and the discipline to ride out volatility. So in the middle of all this tariff and interest rate madness, I made some buys. Today, I'm going to walk you through 2 dividend stocks I bought during the early April panic, 2 more I'm planning to buy in June 2025, and why I think this strategy of collecting stable income while waiting for clarity is one of the best ways to stay sane right now. Before we dive in, let me remind you that this video is for informational purposes only and not financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. I own some of the stocks discussed, but what works for me might not work for you. Alright, let's dive into the first stock, and how the market gave us an opportunity most investors missed. From panic to profits, why I bought when others ran. The moment those tariffs were announced in early April, some investors went into full-blown panic mode. And SOTS? It got hit hard. Analysts started downgrading the stock fast and furious. Some slashed their target prices by more than 30%, warning that air cargo volumes could collapse. The market didn't take long to react. SOTS share price plunged nearly 20%, dropping from $3 to below $2.50. But here's what got me interested. That price wasn't just cheap. It was cheaper than before SOTS had even announced its game-changing acquisition of Worldwide Flight Services, or WFSA, move that turned SOTS into a global air cargo player overnight. So while others were running scared, I was getting ready to buy. Let's pause here. What exactly is SOTS? SOTS is Asia's leading provider of food solutions and gateway services. From in-flight meals to air cargo handling, SOTS is entrenched in the travel and logistics supply chain. And with the acquisition of WFS, SOTS now has global reach, expanding its footprint across Europe and the Americas. That means more scale, more volume, and more opportunities for synergy. Now fast forward just a few weeks, and the rebound came. SOTS recovered hard, up 25% from the bottom. And it could still be early days in its recovery, based on its latest financials, which shows its fundamentals are firing. Earnings more than tripled to $243.8 million. Revenue surged 13% to $5.8 billion, driven by stronger volumes across air cargo and in-flight meals. Operating profit nearly doubled to $475.7 million, with margins expanding from 4.7% to 8.2%. And the final dividend? 3.5 cents, up from 1.5 cents in the same period last year. This isn't just a rebound story, it's a growth story. When others saw fear, I saw opportunity. SOTS wasn't broken, it was just misunderstood. Now, let's turn to the second stock I picked up during the tariff panic. It's a name most Singaporeans know, but few are paying attention to right now. Time to change that? Ignored, then soared, quiet winner in travel's comeback. Now let's talk about the second dividend stock I picked up during the tariff volatility. It's a name most Singaporeans know, but few are paying attention to right now, SIA Engineering. This one is a familiar name for many dividend investors in Singapore, but let's not mistake familiarity for clarity. For a long time, SIA Engineering was just drifting. Its share price had been stuck around $2.40, going nowhere for months. The market didn't seem to know what to make of it, worried about staff costs, inflation pressures, and a rather uninspiring earnings trend. But then came the tariff drama in early April. As the market panicked, SIA Engineering stock dropped nearly 20%, falling below $2. That's when I stepped in. Why? Because while the market was fretting about potential second-order effects of tariffs, SIA Engineering's fundamentals weren't breaking, they were quietly getting stronger. Here's what I mean. SIA Engineering isn't some airline stock flying in and out of cyclical storms. It's the quiet force behind the scenes, a leading maintenance, repair, and overhaul, or MRO, service provider for aircraft. They handle line maintenance at Changi Airport and across Asia, ensure aircraft are safe, and keep global fleets flying. Their business thrives on steady air traffic, not ticket prices, and the recovery in air travel, especially regional travel, continues. That's what made me confident this was a solid pick. Two big things happened shortly after I bought in. 1. A $1.3 billion service agreement was inked with Singapore Airlines and Scoot, a massive endorsement of their capabilities and a steady future revenue stream. And more exciting news, Singapore's Changi Airport Terminal 5 construction is ramping up again, a signal that the long-term outlook for Singapore's air hub is bullish. And if Changi grows, SIA Engineering grows with it. Then came the kicker. Their FY 2025 results. Full-year earnings jumped 43.8% to $139.6 million. Second-half earnings? Up a stunning 87.3% YOY, as aircraft traffic recovered and line maintenance demand surged. Revenue grew nearly 14%, while expenses increased at a slower pace, helping margins improve. And get this, the share price has now jumped more than 40% from the bottom. So while some investors were frozen by short-term noise, I was happy to pick up what I saw as a long-term winner at a discount. SIA Engineering may not be flashy, but it's reliable. And when the dust settles from all this macro noise, I want stocks like this in my portfolio, steady, essential, and underappreciated. Taking a quick copy break here. If you're finding this useful, tap that like button and drop a comment with your own dividend moves. It helps this channel reach more thoughtful investors like you. Alright, back to business. The dividend stocks I'm eyeing in June 2025. Now let's shift gears. After getting some unrealized profits on two travel-related dividend stocks, I'm turning my attention to two very different stocks, but equally strategic, and I'm excited about both of them. A China recovery play hiding in plain sight. In June 2025, I'm planning to buy more of Capital and Investment, or CLI. Why CLI? Because I've been looking for a smart proxy to China's real estate recovery, without diving headfirst into all the risks of owning individual Chinese developers. And CLI, listed right here in Singapore, gives me just that, exposure to China, but with institutional discipline of a Singapore conglomerate and a globally diversified platform. CLI is the investment management arm spun off from CapitaLand Group. It manages over 130 billion Singapore dollars of real estate assets, with more than half of it tied to China. That makes it one of the largest Asia-focused real estate investors on the SGX, and a strong barometer for China sentiment. But here's what I like about CLI: it's not just a landlord, it's a capital recycling machine. It sells mature assets, reinvests in higher yield opportunities, and manages external funds to earn fee income. In May this year, they launched something that really caught my eye. CLI announced its first onshore RMB master fund in China. With a massive 5 billion Chinese yuan equity commitment, they're targeting stabilized, income-generating assets like business parks, retail, rental housing, and serviced residences, all spread across first-tier and top second-tier cities. And just when I thought they were done, CLI doubled down again, this time teaming up with CapitaLand China Trust, or CLCT, to launch China's first international retail-focused C-REIT, called the CapitaLand Commercial C-REIT, CLCR. It's seeded with two mature malls in Guangzhou and Changsha, with 97% occupancy, and valued at around 2.8 billion Chinese yuan. This move gives CLI and CLCT access to China's domestic REIT market, unlocks capital for mature assets, and opens the door to a whole new pool of investors. That's textbook capital agility. Now, I know some dividend investors will ask, but the yield is only 3% plus. True, but CLI isn't your typical yield play. It's a total return engine. The dividend is supported by free cash flow, and with new funds, asset sales, and capital recycling, there's potential for DPU growth in the medium term. So why now? Because expectations are low. Sentiment on China is still depressed, but if the recovery gains pace, even slowly, CLI could re-rate as one of the quiet winners. And if not, I still own a globally diversified real estate manager that generates recurring income and has proven capital discipline. In my portfolio, CLI plays the role of China upside with Singapore structure, that mean assurance of corporate governance. That's rare, and that's why it's the one I'm buying in June. growing while competitors shrink, but I'm waiting for a window. Let's talk about the second dividend stock I'm eyeing closely this June. Shan Xiang. Most Singaporeans already know Shan Xiang as the go-to supermarket for affordable groceries, but its investment story is just as compelling. In Q1 2025, Shan Xiang delivered a solid set of results, but the real excitement lies in its expansion. Shan Xiang originally planned to open just 3 new stores this year. That number has since ballooned to 8 confirmed, with 10 a real possibility. Most of these are former competitor locations, which tend to ramp up faster since shoppers are already familiar with the site. There's also a bigger play at work: the potential windfall from Macrovalue's restructuring of cold storage and Giant. In case you're unaware, Macrovalue is the company which bought over the cold storage supermarket chains from DFI. If unprofitable locations are given up, Shan Xiang could swoop in to secure even more new outlets, especially in mature HDB estates where footfall is high and competition is thinning. But while the business is executing strongly, the share price has already surged more than 10% since mid-April, which is quite a lot for a steady stock like Shan Xiang. The market clearly sees the upside, and that means the easy money might already be made in the short term. So although I'm bullish on Shan Xiang's fundamentals, I'm not chasing it at current levels. I'm staying patient, watching for any short-term pullbacks driven by macro volatility, before making my move. The Dividend Uncle's take. Now if you're asking me what all this means for my own portfolio, well, here's how I see it. SOTS and SIA Engineering weren't just random buys during a dip. They were conviction moves, because even when the market panicked on short-term tariff news, I saw long-term demand for air travel still intact. That's the Dividend Uncle way. Buy what you understand, and what you believe will stand tall when the dust settles. And the recovery in both stocks, up 25% to 40%, suggests that the market is slowly coming around too. Capital and investment, on the other hand, is not the kind of stock that gives you fast thrills. But it gives me something I value deeply: diversified exposure to real estate, especially China, but with the stability of Singapore listing standards. I'm not buying CLI for next week's headlines. I'm buying it because over the next 3 to 5 years, I want a steady operator that can unlock value, grow its fee income, and ride on any China recovery without going all in. And then there's Shan Xiang. Not glamorous, not complicated, just quietly executing and expanding. I've got my eye on it as a buy, though I'm waiting for a better entry point. The fundamentals are great, the expansion story is strong, and in a jittery market, supermarkets tend to be the grown-ups in the room. Now, am I expecting smooth sailing? Of course not. But here's the truth: volatility is part of the journey. Policies flip, sentiment swings, algorithms react in seconds. But when you build a dividend portfolio that's grounded in business fundamentals and strategic diversification, you'll start to see these dips not as threats, but as opportunities. So if you're building a dividend portfolio like I am, not just for the next month, but for the next decade, then maybe, just maybe, these are the kinds of moves worth considering. So there you have it, 2 dividend stocks I bought during the volatility, and 2 I'm eyeing for June. In a market that's swinging from one policy headline to the next, it's easy to feel lost. But when you focus on business quality, long-term trends, and portfolio balance, you start to see the opportunities hiding behind the noise. Let me know in the comments, what dividend stocks are you buying or watching right now? And if you found this video helpful, a like and subscribe would mean the world. It helps more thoughtful investors like you find this channel too. Until next time, stay steady, stay invested.